Canadian markets have spent the year climbing what many are calling a never-ending wall of worry, defying expectations in almost every turn. You got concerns about tariffs, politics, a fragile economy, yet the market has continued to push higher. But with 2026 on the horizon, the questions are getting tougher and the stakes are getting higher. Joining us now to break it all down, Michael O'Brien, portfolio manager at TD Asset Management. Michael, great to have you back on the program.
Yeah, it's always a pleasure, Greg.
You and I have had a lot of discussions this year about Canadian equities. We've been climbing this wall of worry. What was actually behind that resilience? Because in April, it didn't feel like this was a win situation for the TSX Composite Index.
No, it really didn't feel that good back then, did it? So I think, two things that I would point to. First is, the simple fact that all these things we were worried about, it's not like they've disappeared into thin air, but they've been mitigated, they've been delayed, they've been watered down, they've been kicked down the road. So none of those sort of worst case scenarios have actually unfolded. And sometimes not losing is a win. So I think that's been a part of it. The second bigger part of it, though, I think is just that in response to this, policymakers have stepped up. And, we look at that. Obviously, the Bank of Canada has done its part. We've gotten a couple rate cuts this year, put a little monetary stimulus in, protect the economy. But the bigger sea change, obviously, has been on the political front and the fiscal front, with the new Liberal government in Ottawa and Prime Minister Carney and the nation-building projects. And so I think, in one sense, there's the direct stimulative effect of, these new projects that are being announced, a more stimulative fiscal stance. But also I think it's been a real boon to confidence as well and sort of boosted people's optimism a little bit. So I think it's really that avoiding the worst case outcomes, finding a way to muddle through, and then this newfound, optimism about Canada that we haven't had for a while. I think that's really what's pushed the market up, a little over 20% year to date.
Right, so we're feeling a little bit better. That's playing through on the market. Some investors, though, the headlines are coming at us fast and furious. There's so many things to concentrate on. Maybe we can forgive them if they say, "Oh, the tariffs, political uncertainty, all that's behind us." You're still a little cautious, though.
Oh yeah, well, this is not done. The first thing I would just, as an example of this, just think back to the last few weeks, the skirmish between the U.S. and China. We thought we had détente. We thought we had a trade deal a few months back. All of a sudden, China's going to put restrictions on rare earth exports. The U.S. is going to put restrictions on, put Chinese companies on entity lists. Neither side liked that. They both thought they had an agreement. Clearly, they didn't. And so, there was some more brinksmanship. Again, we've stepped back. It's been a de-escalation phase. But that's just an example of all these kind of deals that have been announced, bilateral deals among so many trading partners and such a big part of the economy, that I think some of these deals probably mean different things to different parties. And so I think there's lots of potential for misunderstandings or miscalculations or, just simply different, opinions on what they actually agreed to. The bigger one, though, for Canada specifically is, of all the stuff that has transpired, the thing that's still out in front of us is the biggest nut of all, which is the USMCA. And so the USMCA agreement between Canada, US, Mexico, critical to the Canadian economy, that is up for its 6-year renewal or review. That is really just kicked off. And so this is going to be a story that's going to be with us well into the first half of 2026. And so to me, that's the single biggest issue that Canada has in front of it is, can we land the USMCA at some sort of a palatable arrangement where Canada's favored trading relationship with the U.S. is preserved going forward.
Is that your biggest concern for 2026? What else is on that list?
That would be it.
If that's number one, what else is on the list?
Look, we could have a very long list, but if you want to keep it short, the USMCA is the number one thing that I'm watching in the market today. I think if Canada can land a deal that provides an element of stability, provides an element of certainty so that individuals, households, and especially the business community can begin making decisions, I think that'd be a huge win for the Canadian economy. But as we've all seen, the administration south of the border is very mercurial. Goalposts tend to be moved quite a bit. And so while I'm optimistic that, there is a path to a USMCA agreement here, I'm by no means taking that for granted because, we can see that the carpet's been pulled out from underneath Canadian negotiators a number of times over the course of this year alone. So I suspect there'll be a lot more twists and turns before this is done.
And even when we think about the situation we have with the states right now, because of the existing USMCA, there are tariffs, but a lot of it's exempt under that plan. Now we got the Supreme Court. They've heard the case. Now they're weighing whether the tariffs are even legal. That could be another bump in the road even before we hit 2026.
Yeah, well, it's, I mean, on the face of it, you would think that would be good news if the tariffs are struck down. But, you know, my understanding is that there are a lot more tools in the toolkit. And this would be an inconvenience for the Trump administration. But I think at the end of the day, they're still determined to wield tariffs in some form or another as a, you know, source of leverage, as a cudgel, as a bludgeoning instrument, whatever you want to call it. And so I think there are other vehicles that they could use if these IEEPA tariffs are struck down. So a court decision, it would probably feel good, maybe vindicate some of the feelings that we've had.
You see that headline, you're like, hey, we were right, right? We were right.
Exactly.
Yeah.
What was all that fentanyl stuff anyway? But I don't think we should be under any illusion that you know, the administration would stop at that. I think there will be other vehicles that will be used, similar to the sector tariffs that we've seen that are, you know, really impacting Canadian steel, automobiles, aluminum, lumber. You know, I think we'll see more of those in lieu of the IEEPA tariffs if that's the direction that the Supreme Court pushes them.
The Bank of Canada, of course, you said delivered several rate cuts this year. They've indicated that they're on pause. As far as the Fed is concerned, we're not sure what they're going to get up to in December. The market still thinks there's more to come. How important have those rate cuts been to propping up both economies?
Well, I think, you know, we'll leave the economies for a second. Just in terms of the markets themselves, I think we've seen just in the last couple of weeks here, as soon as you know, rumblings started coming out of the Fed and some of the FOMC speakers downplaying the potential for a December rate cut in the U.S., or even, you know, outright saying we're against a rate cut in December. I think that was really what set off this latest, you know, market wobble. Whether it turns into a full-on correction, we'll find out over the, you know, the next little while here. But you know, so I think for investor sentiment, the notion that the central banks have our backs is very important to keeping those good vibes going. I think in Canada, they made it very clear they've done about as much as they can do for now, given some of the structural changes that are facing the economy, which monetary policy isn't well suited for. And also just the simple fact that inflation here in Canada and in the States is still running at the high end of what we would used to consider a comfortable range, you know, sort of that 2.5–3% range. That's not where, you know, monetary policy, you know, where policymakers want it. So, you know, I think for now, the monetary card has largely been played. In the U.S., I think there's an expectation there's more to come next year, but, you know, we'll see where that takes us. But in terms of the investor sentiment, it's been very important. In terms of the support to the economy itself, obviously, monetary policy, it'll take, you know, 6, 9, 12 months to feed through, but it's a huge support for the economy as well. So I would not dismiss that at all.
Let's jump into some of the sectors now. I want to start with the banks. They have been performing with the market this year. Perhaps are they one of the big performers in the market?
The banks have had a very solid year. Yeah, they're handily outperforming the market by and large. You know, up a little over 30% year to date. So very solid results so far. As we're looking forward, though, I think you know, the bar has been raised. You know, that 30% plus return that we've seen from the banks this year. A decent portion of that was, again, better than expected outcomes. You know, their loan books have been more solid than maybe we would have expected at the beginning of the year, but also a lot of multiple appreciation, so that valuation re-rate. So as we stand here today looking into 2026, you know, the outlook is solid at this point in time, provided the Canadian economy holds up. But when valuations are, you know, in the 13 times forward earnings range, which is at the very high end of where banks traditionally trade, there isn't a lot of room for slip-ups on the earnings front. So that's the real challenge for the banks is, you know, does the economy hold in there? Do the banks deliver the earnings that people expect? Because we're really kind of walking that fine line here. There's not a lot of valuation cushion at the moment.
Sounds like we need to go back to the federal budget on that one. If we're talking about it, can the economy hold up? The Bank of Canada has made clear it's done its part to support the economy. Monetary policy, a blunt tool. So now we have this budget. Is it about execution next year to make sure our economy grows and perhaps the banks can take part in that?
I think there's two parts to it. The first part is the direct impact of what the fiscal measures are, which is trying to direct money to the economy. That pure old-fashioned fiscal stimulus. That is much needed. I would characterize the Canadian economy as fragile right now. So I think we do need that fiscal shot in the arm. The other big part of what the government is trying to do here, beyond just the direct impact of public money being put to work, is really trying to increase the confidence of households, but especially businesses, to begin investing and making decisions. And I think that's ultimately the biggest contribution that this Carney budget will have, if it's successful, is really unfreezing this decision making that I think has really handicapped the Canadian economy this year, and particularly on the business side. If they can win over the corporate Canada and get them investing private dollars alongside the public incentives, I think that could have a real positive effect through 2025. So that's the bull case for Canada right there.
Bull case there, and of course the economy does well. We looked at the banks on that front. What about the insurers? What do they look like in this environment?
I think the insurers look very solid here. If you think about what typically drives the insurer business model, steep yield curves, reasonably elevated long-term rates compared to what we saw the last 10, 15 years. That's a positive for the pure insurance business. Another big part of the profit pool for these insurers is their wealth and asset management businesses. Obviously, as certainly equity markets have had a very strong 2025. If that carries through, so that combination is a really good starting point for the insurers. And then you overlay a reasonable valuation. They're trading 10, 11 times earnings, nothing onerous, particularly in an expensive market. And all of these companies have excess capital, have been buying back shares fairly predictably through the course of the year. So, I like the setup for the insurers.
Oil and gas companies, financially solid, I believe you've said. 2026, I feel like we have a theme here, but 2026 could be a bit tougher. What's going on here?
Yeah, well, I think the companies, controlling what they can control, they're in as good a shape as I've seen in years. Very disciplined, very tight on the capital spending, very committed to returning cash to shareholders. Great stuff. Investors love that. The real question mark there is simply the macro, which is a bit beyond their control, which is where does the oil price go in 2026? And there's a lot of negative sentiment towards the oil market at the moment, and that's predicated on what looks like pretty sloppy supply-demand balances as we go into, especially the next 3 to 6 months should really tell the tale, to see what inventories do. But that's my word of caution on the oil producers, particularly, isn't so much controlling the controllables. It's more just the macro. Does a sloppy oil market weigh on their profits?
When I think about how commodity prices can fluctuate, natural gas, I feel like if I don't turn on my natural gas fireplace enough in the winter because it got too mild, this is a sector that can sort of lag. But you have a little bit more optimism here for that.
Yeah, well, I mean, for years it's been sort of a meteorologist's playground. You know, if you get a cold winter and you bet on the natural gas stocks. But the big fundamental change for the Canadian producers has been the ramp up of LNG Canada on the West Coast. That is a game changer. It's ramping nicely now, should carry into 2026. So hopefully that'll tighten up gas markets in Western Canada. And the second element of that, which is more sentiment driven, is if you look in that major projects list, we now have 2 very large LNG projects on that major projects list. Hopefully, heading towards final investment decisions, project sanctions sometime in 2026. That would be a huge medium-term support, again, to tighten up that Western Canadian gas market.
Got less than a minute left, but if an investor wanted to have a picture in their mind about 2026 and Canadian stocks, what should be the takeaway?
I would say adopt a balanced outlook on this. There are a lot of things to be positive about. This renewed optimism around getting things done in Canada, that's a game changer. That is very important. But at the same time, I think we need to recognize it's a very fragile underpinning for the economy right now. And so the one thing that I would, again, emphasize we watch for is USMCA. Can we settle this trade issue? Can we put that to bed and start getting on with business?